industry has reformed past excesses, notwithstanding the fact that pay and bonus packages in many cases seem to have reached pre-crisis levels. And while it appears that more of this compensation is being paid out in restricted stock, it is unclear whether this represents lasting reform. As troubling as outside bonuses are, this AMPR is not about the appropriate level of compensation, which surely is a matter for boards and the shareholders that they represent. It does ask, however, whether certain compensation structures encourage institutions that we insure to take imprudent risks, and if so, should that be factored into our risk-based assessment system. As deposit insurer responsible for managing the resources of the Deposit Insurance Fund, this type of risk evaluation is central to our mission and purpose. I am confident that our work will benefit from the fact that supervisors such as the Federal Reserve are also looking into this issue. I am equally confident the Feds and our efforts here will complement each other as they do in so many other areas. Capital strength, asset quality, stable liquidity. These are all factors integral to both the supervisory process and our risk-based deposit insurance premiums. In all of these areas, our risk-based premiums complement and reinforce the supervisory process. With that, I would like to ask the staff to present the draft AMPR that will serve as a first step towards our gaining a better understanding of the degree of risk that certain compensation practices pose to financial institutions and the Deposit Insurance Fund. So we'll have Mark Steckel, Dan Lonegron, Rose Kuschmeider, and Chris Bellata will present the case.
Thank you, Chairman Bear, and good morning. This case requests the Board's authorization to publish an advance notice of proposed rulemaking for a 30-day comment period in the Federal Register. Staff is recommending publication in order to obtain public comment on how the deposit insurance pricing system could be used to address risk presented by poorly designed incentive compensation programs. Both academic research and evidence from recent bank failures show that poorly designed incentive compensation programs can promote excessive risk-taking and can contribute to the cost of financial institution failures. Programs that award immediate cash compensation based on attaining an amount of income or business production, and which don't also have effective safeguards to limit the risks which can accompany striving for these goals, have been problematic. The Basel Committee and the Federal Reserve Board have acknowledged these issues and have offered supervisory policy responses. The FDIC, in its supervisory capacity, is currently working with Federal Reserve staff on its effort. The proposed approach set forth in this ANPR is designed to complement supervisory efforts by rewarding banks that can achieve voluntary standards above the thresholds mandated by supervisors. We believe that supervisory efforts can be strengthened by the FDIC's effort to reward banks that voluntarily achieve higher standards. The proposed approach is targeted toward compensation structure and contains no features which would limit the amount of compensation paid to high-performing employees. Specifically, banks using programs that contain the following three features could qualify for advantageous treatment under the risk-based deposit insurance premium system. First, a significant portion of compensation for employees whose business activities can present significant risk to the institution and who also receive a portion of their compensation according to formulas based on meeting performance goals should be comprised of restricted, non-discounted company stock. Second, significant awards of company stock should only become vested over a multi-year period and should be subject to a look-back mechanism designed to account for the outcome of risks assumed in earlier periods. And third, the compensation program should be administered by a committee of the board composed of independent directors with input from independent compensation professionals. Using such an approach, the FDIC could either reward banks that meet the standards with lower assessment rates, or conversely, could charge higher rates to those banks that chose not to meet the standards. The ANPR concludes with a series of questions concerning the scope and applicability of the rule. Staff has purposely remained somewhat nonspecific on several aspects of the proposed structure so as to encourage a broad array of responses and ideas for improvement. Does the board have any questions?
Great. Thank you very much. Vice Chairman Grimberg.
Thank you, Madam Chairman. I'm prepared to support this proposed advance notice of rulemaking. The purpose of this ANPR, as I understand it, is to seek public comment on the feasibility of incorporating the risks posed by employee compensation programs into the FDIC's risk-based pricing system. I think in light of the risks posed by compensation programs, that's a worthwhile goal. I think the feasibility of achieving it is not small. And in fact, the ANPR points out that while there is general agreement that certain compensation programs misalign incentives and increase risks, the proposals to address these problems differ. In some, identifying the risks posed is easier than identifying the appropriate solution to address them. So I don't think this is an easy matter, and I frankly don't approach this issue with a presumed outcome. I think the effort here is to pose an open-ended set of questions and to seek public comment on the feasibility of undertaking this effort. And on that basis, I think it's a worthwhile undertaking, and I'm prepared to support it. Thank you very much.
Thank you. Director Curry.
I also support the proposed ANPR. Recent experience shows that excessive employment compensation practices have had an impact upon the risk profile of insured depository institutions. An organization's compensation practices clearly are a relevant risk factor in determining deposit insurance premium or assessment levels. I think the proposed ANPR is a good way to start the process of incorporating adjustments for employee compensation practices into our risk-based deposit insurance assessment system. I share Chairman Baer's goal of using risk-based assessments in order to, one, adequately compensate the DIF for risks presented by certain compensation programs, two, to encourage banking organizations to adopt compensation programs that align employee interests with other stakeholders, particularly the FDIC, and three, to promote the use of compensation programs that foster sound risk management practices throughout the organization. The FDIC's staff's proposed approach, which describes three essential components to a sound employee compensation program, is a good starting point. The use of restricted, non-discounted stock with multi-year vesting features, as well as performance lookbacks, all of which are administered by an independent board committee with input from independent compensation experts, are key to sound compensation programs. The ANPR's basic framework, with the 15 specific questions it poses, merit further public and industry comment. I think robust public comments will be very useful to this board as we develop appropriate incentives for employee compensation in the context of our risk-based assessment system. Thank you.
Great. Thank you very much, Director Curry. Director Dugan.
Thank you, Madam Chairman. Executive compensation is a topic that has drawn scrutiny from numerous quarters in recent years. As Congress, the executive branch, financial institution regulators, and scholars have tried to understand the factors contributing to the recent crisis and how to prevent a repeat of those events. There is little doubt that in the mix, some employee compensation schemes encouraged excessive risk-taking by financial institutions, both large and small, to the detriment of both individual firms and the financial system as a whole. Legislators and regulators both here and in other countries are currently taking steps to address this problem. In so doing, however, they all confront the real and difficult issues that arise when the government treads closer to prescribing compensation types and levels for private business, a process that can also run the risk of substantially and unnecessarily increasing regulatory burden, especially for smaller institutions. While I believe that additional carefully crafted steps by regulators to address executive compensation risk are appropriate, I do not believe that the draft ANPR is one of those steps, at least not at this time and not with the approach currently presented. I have two major concerns. First, issuance of the ANPR would be premature. Congress has recently taken up legislation in this area. The Wall Street Reform and Consumer Protection Act, passed by the House of Representatives in December, included specific rulemaking requirements for all the financial regulators. Those rules would require the disclosure of all incentive-based compensation to the financial regulators and prohibit incentive compensation that could threaten safety and soundness or have serious adverse effects on economic conditions or the economy. There is every reason to believe that a Senate bill would also address this topic with a similarly coordinated approach among regulators, which makes sense. In addition, the Federal Reserve Board is currently developing significant guidance on sound incentive compensation programs covering all banking organizations, with material input from the other banking regulators. This supervisory approach would not prescribe or limit incentive compensation as a specific approach, as would the features suggested in the ANPR. Rather, it seeks to ensure that incentive compensation programs discourage excessive risk-taking and incorporate prudent risk management principles and effective quality controls. Unlike the uncertainty of waiting for legislative proposals to become law, coordination and consideration of the final work of the board is quite feasible. It would be very unfortunate to have an end result where insured institutions, and perhaps their holding companies, were subject to inconsistent schemes evaluating the risk of their executive compensation programs. I think we should wait until we have the results of the board's efforts before heading down a path that would be both unnecessary and inconsistent. This leads me to my second concern. I do not believe that a sufficient basis has been demonstrated to support the approach in the draft ANPR. While the FDIC's rulemaking authority to establish a risk-based deposit insurance system is broad, it is not limitless. The risk factors used in the system must relate to the, quote, probability that the deposit insurance fund will incur a loss with respect to a particular institution. Citations in the preamble to works of academics and consultants simply do not provide an adequate basis to support the broad approach described in the ANPR. Nor are the material loss reviews helpful to support the ANPR's broad approach. These reviews deal with a limited and arguably unrepresentative group of institutions, mostly smaller. When an MLR does mention excessive compensation, it tends to be general and not specific. And when specific types of excessive compensation are mentioned, the situations are overwhelmingly ones where loan officers were rewarded simply based on the volume of loans originated without consideration of quality. In contrast, the ANPR's very particular approach would apply to a much broader array of compensation arrangements for banks large and small for which there is no empirical connection to losses sustained by the deposit insurance fund. In short, I have substantial concerns about trying to address the real problem of risky compensation arrangements through finely calibrated increases in deposit insurance assessments. Where there are clearly identified problems, I think we ought to address them first through supervisory guidance and direct examination and supervision, as the Federal Reserve Board process provides and the congressional process plainly contemplates. Only if that is inadequate should we consider other measures. For these reasons, I cannot support the ANPR.
Thank you. Director Bowman.
Yes, review of compensation practices at healthy institutions has long been a component of the supervision of federal and state bank regulators. However, the review has been in the context of the review of management as part of the CAMELS rating. After the last crisis, interagency guidance on compensation was adopted, that finds that excessive compensation is an unsafe and unsound practice. FDIC and other federal banking agencies have authority to regulate compensation arrangements pursuant to their general authority to supervise safety and soundness. Section 8B of the FDIA provides additional authority in this regard. It authorizes the appropriate federal banking agency to take enforcement action against any insured depository institution that is engaged or is about to engage in any unsafe or unsound practice. Staff cites a series of material loss reviews by the FDIC's IG's office where it was found that compensation plans were, quote, a contributing factor in the failures of the particular institution. Invariably, the other factors included concentration and poor loan underwriting by the institution. All of the failures also reflected supervisory determinations as expressed by the CAMEL ratings of the failed institutions, in particular, low asset quality and management CAMEL scores. Staff does not focus on the other statements of the MLRs, which include a reference to the provisions of the November 12, 2008 interagency guidance related to, quote, meeting the needs of credit-worthy borrowers. I serve on the FDIC's audit committee, charged with reviewing all material loss reviews, and in several of the material loss reviews cited by staff in this exercise, similar language is found. Quote, "The FDIC and the other regulators have increased their focus or taken actions to provide guidance on compensation guidelines," referring back to the November 12, 2008 guideline mentioned above. The same language in a number of audit material loss reviews goes on to say, quote, "Poorly designed management compensation policies can create perverse incentives that ultimately jeopardize the health of a banking organization. Management compensation policies should be aligned with the long-term prudential interests of the institution, should provide appropriate incentives for safe and sound behavior, and should structure compensation to prevent short-term payments for transactions with long-term horizons," unquote. The IG statement goes on to say, the statement, again referring back to the November 12, 2008 statement, emphasizes that the banking organizations are expected to regularly review their management compensation policies to ensure that they are consistent with the long-term objectives of the organization and sound lending and risk management practices. We, in this case I'm speaking for the IG, consider performance bonus programs that do not address asset quality objectives to be a significant concern, which we address in our summary reports covering multiple bank failures, close quotes. In that language, I do not find a recommendation within those reports that would suggest that, one, compensation plans were the only cause of the failure of a particular institution, or two, that existing statutory and regulatory authority and or guidance were not sufficient to deal with the issue going forward. That is not to say that there might not be some issues related to the utilization of existing authorities by the federal and state prudential regulators that could have improvements. In that regard, there are multiple regulations and supervisory guidance related to this issue already, and I'll quote a few. General Authority to Supervise Safety and Soundness, Section 8B of the FDIA. And again, I go back to Material Loss Review that talks about excessive compensation plans as possibly being a safety and soundness issue. The November 12, 2008 interagency guidance related to meeting the needs of creditworthy borrowers, which, as I said earlier, specifically refers to compensation plans that provide perverse incentives. 3, interagency guidance required by FDICIA, which prohibits excessive compensation, statutorily prohibits excessive compensation as an unsafe and unsound condition. Then we have individual chartering authorities, including the states, that have statutory requirements that compensation plans for de novos be reviewed and approved by the regulator. And in fact, one of the material loss reviews quoted by staff, they cited a failure of the appropriate state chartering authority to have accomplished that. Currently, as Director Dugan has mentioned, the Fed is currently processing a notice of proposed rulemaking related to compensation that could be available for interagency participation based on general, and I would suggest a much stronger legal basis. We have FDIC's limits on golden parachutes, which apply to all insured institutions. Beginning on February 28 of this year, pursuant to the Proxy Disclosure Enhancements Rule of the SEC, public companies must disclose how their compensation policies and practices relate to risk management and the extent that risks arising from these policies and practices are reasonably likely to have a material adverse effect on the companies. Finally, even if the regulation of incentive compensation through assessments were sound public policy, this ANPR is premature. Congress is currently debating whether to require additional disclosures and substantive restrictions on compensation for public companies. We do not know yet what those restrictions will apply in terms of incentive compensation. Excessive compensation practices at the largest banks and companies have received much attention in the press and otherwise is seen as one of the factors that caused the current crisis. I understand that there are examples of compensation plans where there is every indication that the incentives built into the plans are contrary to the safe and sound operation of the institution and to good public policy, particularly in these times where the American taxpayer has been asked to bear significant risks related to the health and viability of these same institutions. I get that. But let's look at some of the numbers related to, quote, average bank employee compensation in this country. I emphasize the word average. As reported in the ABA's 2008 Compensation and Benefits Survey, the following positions across all asset size received, quote, average salary and benefits as follows. CEO, $239,400. Chief Operating Officer, $162,100. Chief Financial Officer, $140,900, and I can go on through the list of primary officers. I think those numbers should be kept in mind when we start to see the reports on year-end bonuses from Wall Street companies. I also think compensation, including incentive compensation plans at the vast majority of insured institutions, are well below the threshold that should rise or would rise to the level of concern by this board. I also believe that we've not done sufficient empirical research that establishes the link between incentive compensation and excessive risk-taking that causes a loss to the Deposit Insurance Fund as it relates to the vast majority of institutions. It is true that several of the material loss reviews of banks that have failed in the past year have referred to incentive compensation of individual employees as a contributing factor in the failure of the institution. But again, it is critical to emphasize the word contributing in that analysis. So how does a federal agency begin to take on this task of measuring and approving a compensation system to determine whether that plan first must be approved by owners, boards of directors, shareholders, account holders in the case of mutuals, and other stakeholders? And I would suggest not including the FDIC, who I would argue is not a stakeholder, but rather just the insurer in this matter. Compensation has long been a part of the business of the owners of companies, including insured institutions. Boards of directors have a fiduciary responsibility to ensure that compensation arrangements are not excessive, given the resources of the company, the competence of management, and the general operations of the company. In conclusion, I will be voting against this proposal for the three reasons. One is I believe it's premature. Congress is currently considering statutory language which could, depending upon where the final language is written, could deal with some of the same issues we are concerned with here. Two, regulatory action. Director Dugan has mentioned the Notice of Proposed Rulemaking by the Federal Reserve, which I believe in the appropriate circumstances could be an interagency proposal and would deal, I believe, effectively with some of the same kinds of concerns we are talking about here. And finally, three, I need to ask, what are the limits of the FDIC's authority to include in the DIF assessment base factors other than those explicitly set out in 12 U.S.C. Section 1817 and 12 CFR Part 327? Are we setting a precedent for utilizing the DIF assessment system for purposes beyond what Congress intended? Thank you, Madam Chair.
Thank you, Director Bowman. Well, as always, it's regrettable when we have a split vote on this board, but I must say, I think to take a position that we should not even be asking these questions is not one that I can understand. I also cannot understand why we need to keep waiting. We need to keep waiting for this or that, and in the interim, nothing changes. We just maintain the status quo, and the longer we try to instigate meaningful reforms, the more momentum for that dissipates. We are simply asking the question, and there are a number of MLRs for the smaller institutions that draw quite a clear contributing factor to bank failures and losses. We don't have MLRs for the large institutions because they got bailed out. But that does not mean to say that we shouldn't be looking at the skewed compensation systems at the larger institutions as well, and how that fit into risk-taking and the credit crisis, which has obviously imposed massive losses for the Deposit Insurance Fund. So we must rely on academic research and other work done by our own staff to determine whether there is cause and effect here. We're asking the question right now, but we are obliged to have risk-adjusted premiums, and we are obliged to evaluate risk to the Deposit Insurance Fund, and we are obliged to try to factor in those risk elements into our premium structure. So I think there's nothing we are doing that is conflicts with what the Fed is doing. It complements that. There is nothing we are doing that conflicts with what the Congress is doing. Congress is acting in a number of areas impacting risk with regard to insured depository institutions. Again, these are complementary efforts. They are not inconsistent, but to suggest that this agency should not do anything when there is such an overwhelming amount of evidence that this is clearly a contributor to the crisis and to losses that we are suffering, I just cannot understand that. John, you made a very good inventory of all the different regulatory and statutory provisions dealing with management and compensation, but I must say, how effective has those been? And maybe we should be looking at some other tools as well to, again, reinforce and complement those supervisory efforts. I think the regulators have been roundly criticized for not fully exploring the regulatory tools we have at our disposal to address some of the root causes of this crisis. So I think it is incumbent upon this board to fully explore the tools we have available to address risk to the deposit insurance fund, to the banking system, which clearly is not within our authority, but is within our obligation pursuant to congressional directive that we should have risk-weighted assessments. So I regret, again, that we could not all come together on this, but I think this is worth exploring. As Vice Chairman Grunberg said, this will be a difficult task. Defining the compensation structures that we want to incent, either with a carrot or a stick, will be difficult. Calibrating the amount of financial incentive, if we move ahead, will also be difficult. But I think there are a lot of smart people out there that can help enlighten us on this subject. So again, not to even ask the question, I think, would not be responsible for this board to do. So that may have a motion with respect to the ANPR on employee compensation.
I move.
May I have a second?
Second.
All in favor say aye.
Aye.
All opposed say nay.
No.
Thank you very much. The motion passes 3-2. That concludes the discussion agenda, and we will now move into a closed session. Thank you.